Stocks falling sharply on Wall Street as Fed Chair Jerome Powell spoke publicly this afternoon. Let's find out what unnerved investors this Thursday. We're joined by Victoria Fernandez. She is Chief Market Strategist at Crossmark Global Investments in Houston. Welcome back, Victoria, and good afternoon to you.
Hello, Fred. Good to be back.
So, Victoria, we've got the 10-year yield spiking to 1.55%. It was 1.47 before Powell spoke. So what was it that he said that unnerved investor sentiment?
You know, it's interesting, Fred, because as I was sitting there listening to Powell and then watching the market move higher, I was trying to make the two, actions mesh together. You have Powell saying, again, we're not going to do anything anytime soon. We're going to stay accommodative. This is what was supporting the market up until probably the last month or so. I think what may be happening is that the inflation fears that the market is seeing right now, you have Powell saying they are going to be transitory inflation rises, and so they're not going to move based on those. And perhaps the market is losing a little bit of confidence in the Fed and that they're going to be able to control rising inflation. So the bond market is reacting. And actually, I probably shouldn't say bond market. I should probably say the treasury market, because the credit market actually is not moving and is staying pretty steady at this point in time.
Right. Powell pledged, or repeated his pledge rather, to keep credit loose. And but he did say he did not see the rise in treasuries as a treasury yields as a disorderly move. Could it be that? Was it something that investors needed to hear more of or stronger?
It could be. It could be that they really want to hear Powell say, we see the move that was made. We see how quickly rates moved higher, and we're paying attention to that. I think the fact that he says, yes, I saw that, it caught my attention, I think were the words that he used, but that they're still not going to do anything about it at this point in time is bringing a little bit of worry into the treasury market.
What they wanted him to say that, hey, we're going to keep buying more bonds or booster purchases? Is that what it was?
They always love to hear they're going to buy more bonds, right? They like that phrase. I think they want to see that the Fed is paying attention to what many in the market see are true inflation pressures that are coming, and not just, maybe some people would say, sweep it under the rug as transitory at this point in time. They want to see them take a little bit more accountability in regards to what they would do with inflation moving higher.
So looking ahead, Victoria, in the next few weeks, how much higher do you see treasury yields rising?
Yeah, it's interesting because we look back at where we were a year ago, we were higher than this, right? Right before the pandemic hit, we had the yield curve actually higher than this on the 10-year part of the curve, and people weren't really concerned about it. And now we're very concerned that we're moving higher, but not even back to that point. So I think we have a little bit of room to go. I don't think we're going to hit a 2 handle on the U.S. 10-year Treasury. I think that really would unnerve the markets and really cause more volatility in the equity side of the markets. But I wouldn't be surprised to see us go another 15, 20, 25 basis points, but just not at the same speed that we've seen this current move.
Conversely, what about the equity markets? The NASDAQ is now officially in correction territory. How much lower or deeper do you see the NASDAQ or, say, S&P 500 falling from this point?
So much of this move is really this knee-jerk reaction to treasury rates moving higher, because especially those NASDAQ names, those tech names, are kind of what people consider longer duration equity names, right? And so those longer-term cash flows are really affected by higher rates. And you also have that old adage that the TINA, right? There is nothing else that you can go to besides the equity market. And maybe that's being called into question a little bit as treasury rates move higher. So how much further can the equity market move? I don't really have a number on that, but I'm not surprised to see it have a pullback. I would anticipate now maybe we're getting closer to some consolidation within the markets, both on the equity and the fixed income side. So perhaps we start to have a little bit of a lull, and that might allow investors to take advantage of the pullback and get into some tech names they'd missed previously.
That was my next question. So how should investors reposition themselves or take advantage? Should they be buying, for example, big cap tech stocks on these dips?
So we actually see any kind of major pullback like this as what we call an upgrade opportunity. So maybe coming out of some names that we've held for a while, but we think there's better opportunities and we've been waiting for a good price movement to get into those. NVIDIA is one of those names. So you see the huge pullback, but you look longer term, because you know we're longer term investors. These are still good growth names in the tech sector that we think are going to continue to do well and even do better perhaps than what they did over the past 5 years as we move more and more into tech in our everyday lives. So we think there's good growth opportunity in some of these names, and this would be an opportunity to get into those.
All right. Thank you, Victoria, for sharing your analysis on this big day. Our thanks to Victoria Fernandez of Crossmark Global Investments. I'm Fred Katayama in New York. This is Reuters.